really convinced that I found the strategy, or I found the method within the strategy when it comes to covered calls, really making money in the stock market when the market is down, when things aren't really certainable, when your portfolio just keeps doing this, right? And when the portfolio keeps doing this, it's just a a point in every journey that reminds me that, like, hey, when we're down here, when we're at these down points, that doesn't mean quit, that doesn't mean give up, that doesn't mean get disencouraged. And then also when we're at these top points here, that doesn't mean we know everything, that doesn't mean we inflate our ego. We still want to stay humble, ladies and gentlemen. So that's definitely something I'm learning amongst this journey, ladies and gentlemen. It doesn't matter what point that you're in your journey. The point is you just keep going. You keep rinse and repeating the process. Ladies and gentlemen, I go by Ali Mavis. And if you don't know me by now, I suggest you stop and watch my other videos. Why? Because listen, if I ain't the greatest, then I'm headed for it. If I ain't the greatest, then I'm headed for it. I'm just kidding. No, seriously, if you have less than like $7,000 and you want to invest in the stock market, my videos is for you. Because I remember when I was in your shoes. And I really wanted to get started, and I didn't have anybody that I could talk to or someone that I could relate to every single day to give me some videos. Like, there's a lot of videos on YouTube, right? But are there videos that are consistently showing the journey and like showing the results of the journey, right? So, and I'm not to say there isn't anybody out there, but if you're depending on somebody, I have videos since November 13th, 2025, ladies and gentlemen, on how to invest in the stock market. But for those that have been watching me and know how I get down, let me give you guys some of the plays today, ladies and gentlemen. So, we got a couple things that are up today. Oh wow, this expires today. Oh my god, I'm a little sick at myself, to be honest with you. I'm a little sick with myself. If you guys watch my previous videos, okay, yeah, if you guys watch my previous videos, even right now, I would still be up on these contracts. So if you guys watch my previous videos, I had the 719, 718 put credit spread on SPY to end today. I've got on that contract, I got a $99 credit. 99, like pretty much the max that you can get right now. Even though SPY isn't close to because of 719, I would still be making money on this option, but I got scared out and whatever. So go watch those last videos so you guys can see what I'm talking about. But ladies and gentlemen, let's find some stocks that we can buy today that is red, that we can get into for $1. Buying stocks for $1, I see you guys like to clown and you guys like to say stuff. Yeah, you like to say some mean stuff over the online. Oh, bro is only up $2. Bro is only up $8. Bro is only up a couple cents. But it's like, yo, what? Why are you guys hating? To be up a couple cents and to share that too with other people on how to make a couple cents, because there's people that have literally dead money sitting around and they're too scared to invest in the stock market because they don't want to lose what they have, knowing that you don't even have to put everything what you have in the stock market. You know, like, look at that. Today we only bought 2 stocks. Everything is green today. Everything's super green. We could buy a little bit of Coca-Cola. We'll get $1 Coca-Cola. We get some Coca-Cola. Everything is green. Only 3 of my stocks are red. I'm gonna go over how I buy my stocks, when I buy, and all that. So let me go over that with you guys for this strategy. So for example, this one, Lowe's. Lowe's is gonna be a perfect example. So my average cost for Lowe's is $240, right? Meaning that every time I bought into Lowe's, it was $240 and above. So right now the average cost for Lowe's is $235. So I'm down 85 cents. What I like to do with companies like this, if I'm down, and it don't matter if the stock is down or up, but if the stock is lower than my average cost, I'm going to buy 10% of my market value. So my market value is $40. So I'm going to buy $4 worth, right? And every time my market value goes up, I'm buying 10% of the market value. So when I buy $4 worth, look what happens. It only dropped me pennies. Pennies. So imagine if I only bought $1 worth. It barely would have made it barely would have made a move on my Lowe's average cost. So think about that, ladies and gentlemen. What I did was basically bring my average cost down, meaning that my break even is no longer where it was. My break even is a little bit lower now. So that's my mindset on how to buy when stocks are down. When stocks are up and I'm up, I only buy $1 worth of it. For example, Nvidia, I only bought $1 worth of it because the price is higher than my average cost. And if I buy a lot at this price, my average cost will go up. Stocks is a lot to do with average cost. Has a lot to do with average cost. I'm going to go over some of my plays here with you guys. If you guys stick here with me, you guys are going to get something out of this video. Look, we're up on my shares. We're up on everything, basically. I'm going to go over plays with you guys here. First play is Coca-Cola. Tomorrow's expiration date. We have one contract, the 77 strike price. If Coca-Cola remains above $77, I am obligated to sell my 100 shares at $77, meaning that I don't get to keep this appreciation that Coca-Cola has. Meaning that I bought Coca-Cola, average cost $76.33. I'm selling it at the 77. So that means I'm going to make $67 on the appreciation, and I'm also going to make another $54 on credit. This extra $103 I'm not making on the appreciation of Coca-Cola. But that's fine, because the money comes back to me. I get to rinse and repeat, and we get to find some other plays. Next play, we got AT&T, which expires tomorrow. It is a $33 credit. We got $15 out of it already. AT&T is at this price. So look at this right now. We're down $12, but our contract is up 15. So I can take money from the contract, sell my AT&T shares, and I'll be up just a couple dollars. Another set of plays I have here, ladies and gentlemen, is these AT&T call credit spreads. I believe that if AT&T does go down, I want to be a part of that. If it doesn't, I won't lose too much money on this because I'm only risking $7 per contract on this call credit spread. If AT&T goes down, which would be lovely, I would be milking the premiums and the options. Next one, ladies and gentlemen, this is where I'm learning and I'm peeping game that to do these covered call strategy, to be honest with you, it's better to actually buy in 10 shares a day, accumulate your 100 shares, and then start your option strategy. I think to start the strategy, it's better to start it at covered call than to do it at a cash secure put. I'd rather do it at a covered call than a cash secure put. Why? Because with a covered call, depending on how much money you have in your account, a lot of times you're already starting on margin. So if I put like 3K in my account, I probably have 5K, I have 6K. So I can borrow more money to buy more stocks. But when you're doing the cash secure put, you can't use borrowed money to put down on the cash secure put. You gotta actually have the money available. So it's like, hey, if I have 3K and they're gonna loan me 3K and I can buy 6K worth of stocks, I'm gonna do that and then work the wheel that way. Versus if you have 3K and they can't loan you money and you gotta put up 3K to buy stocks or to do your cash and carry put. I don't know. That doesn't sit well with me. For example, my account $7,748, but look, I have 200 shares of Coca-Cola. 200 shares of Coca-Cola. Just the market value itself is 15K. Just the market value itself is 15K. I have another just almost 300 shares of Sofi. Just the market value itself right here is 4K. That's already 20K. But my account is $7,000. So I'm able to borrow money to buy these stocks. But if I was doing the cash to care put way, I wouldn't be able to buy a cash to care put because I got to use all my funds. So I say all this because this company here is a holding company of like cigarettes and tobacco and all that. And up today 5%. But what I've been doing is buying into this company slowly to accumulate my 100 shares. And my thought process is actually kind of working out because I feel like once I get to my 100 shares, let's say I'm up. Let's say I'm just going to use today's example. I'm up $300, right? I'm up $300, and let's roll to the next week. We're up $300, and I could probably get like, let's say mess around and get wow, these things snapped. I can get like the $8 covered call, right? $8 covered call. It's not a lot of money. I'm only getting $8. But if this thing's appreciate to 76, that's another $400. And this company pays dividends. So it's like I'm already up on the appreciated asset. Covered calls now, I'm not trying to chase a lot of premium. I'm just trying to get a couple bucks. Just trying to get a couple bucks that this way if this thing rips, I made a lot of money on appreciation and I'm still making back end premiums. So what I'm seeing from this is next time when I'm doing these cover call strategies, I'm going to just start buying in. For example, here, if you watched my video yesterday, my average cost into Sofi was 19 and change. Right now it's 18 and change. Yesterday, if you watched my video, I only had 200 shares of Sofi. Now I have 280 shares. And my goal is to add another 20 shares, lower this average cost, and then start working my premiums at the 18 strike. At the 18 strike, looking at some that will help me kind of mitigate my losses. So buying and average costing your positions is super key. It's super vital. Like, you have to learn how to do it, because if you're not, you are going to be stuck under the market's hands. So ladies and gentlemen, that concludes today's video. If you aren't already following me on my social medias, go ahead and follow me on TikTok and Instagram at Strictly Financial. Ladies and gentlemen, the month is over. We're now in May. We're 5 months into the year, and look at the progress. Look at the progress. So we're 5 months into the year, and it's just been a small piece of the pie as far as timing, and there's a little bit of success, but I want this to be something that is proven over time, something that's going to be done over time to show that, hey, if you have a little success with a little bit of money, with a little bit of time, can you imagine what the success would look like if you have a lot of bit of money and a lot of bit of time? So ladies and gentlemen, I end you guys with that, and we talk tomorrow, because tomorrow is expiration date, ladies and gentlemen.